Hello, everybody. Welcome to Zoe's Treasures. My name's Tracy, and as always, I'm here with my husband, Noel. Good. I almost said good morning. Good evening, Southern Charm. Hello, happy Friday. This is our second show of the day, so this is our continuation of our morning live seller collection show. So this morning we talked about how to get by on the slow weeks. Well, you're very welcome. Thank you for being here. I appreciate that. So we talked about how do we get through the slow weeks? How do we survive when, all of a sudden you do a show and you're like, what the heck? What happened? Why is nobody buying? And what do we do? So that was this morning's show. If you're interested in watching that one, it is on YouTube. So you can always go to YouTube to see any of our past shows. Hi, Tabitha. Yeah, I redecorated already. Just like that, I switched up my basement. I wish it was that quick. I think this is going to be quite a process to switch up my basement. So tonight we're kind of continuing that, and we're going to talk about using your business losses strategically. So a little bit about what does it mean to have a business loss? How does the IRS view that? How is it kind of viewed just in general? Is it good? Is it bad? All that stuff. So to even kick us off and start tonight, let's see. Let's start with the giveaway because I forgot to do giveaways this morning, so I felt bad. So we're going to start with the giveaway. We are doing CEO affirmation cards. They are the standard Zoe's Treasures giveaway. That is what we're doing. So let me ask you a question. Have you ever finished a year? If for those of sellers who've already gone through a whole year, have you ever finished a year and like all year you're killing it? You're like busting your butt. You're working hard. And then you get at the end of the year and you're like, man, I really didn't make much money this year. That ever happened to you? I've been there. Happened to me. I Love Discounts is like, yep. Midnight Metal, yep. It happens. You can work so hard and still lose money. We're going to talk about that. The next question I want to follow up with, how many of you have felt that and then thought, man, that was a failure? Because I sure had feelings of failure when I see a loss. And that's what I'm part of what we want to touch on tonight is most people, for sure, it's restructure. Yep. All the time. And it's normal. A lot of people think profit equals success and a loss equals failure. And nothing can be further from the truth. It is not, we're conditioned to think like that, but that's not the truth at all. So I really hope if you ever saw a loss on your books, or got to the end of the year and you did a tax return and saw a loss, that you don't feel like a failure. It's not. We're going to talk about what does it really mean? Because businesses don't work that way. Businesses, profit doesn't always equal success and a loss doesn't always equal failure. So first of all, losses can be very strategic. Losses can offset other income. You can really use it to reduce your taxable income. And I'm not saying doing anything, the wrong way or being sneaky. We're totally on the up and up, doing everything legally. But a legitimate business loss can potentially, in most cases, reduce taxable income. Let me give you an example. It's particularly helpful for if you have a W-2 job. So you're working for somebody else, you get a W-2, they're withholding the payroll tax, and then you've got to go ahead and file your tax return. At that point, all of the rest of that money is taxable money, right? But if you have, say you have $15,000 W-2 income and a $3,000 business loss on your Schedule C, that can offset each other to where then your taxable income only becomes the $12,000. So your business losses can reduce your W-2 income. This could be a positive for you. Some of the stuff we're going to talk about tonight is thinking through, understanding your position so that you can project where you're going to be tax-wise to start to say, hey, maybe a loss this year isn't going to hurt me. Maybe I do need to buy a few more things and take a little bit of loss. What if you work a W-2 job and you did really, really well, and all of a sudden, come like October, November, your boss is like, guess what? I'm going to give you a big old bonus. And you didn't expect it. And you're like, uh-oh, this is going to cost me in some taxes. There may be times where you want to strategically play with your business and your W-2 to create the loss to offset the income. Now, we never run businesses to try to get losses. but it does happen, and we could take lower taxable income in certain cases. When I get to the end, I'm going to give you some of the things that how we can lower our taxable income while not touching our book income. We'll get there in a minute. So I want to make it really clear though. When you have a business loss on your Schedule C that offsets a W-2 gain, offsets your W-2 income, that's not like making money on taxes. You may hear some people refer to it like that. It really couldn't be farther than the truth. A loss is still a loss. So while we're going to talk about taking a business loss, and I'm like, don't think of it as failure. We're learning and a lot of other reasons. A loss is still a loss. That's not the ultimate goal of what we're getting at, but it is the reality in a lot of situations. So let's talk about what the reality may be, particularly for newer sellers. And what does that mean? The tax code recognizes that businesses have expenses and businesses have setbacks. So the IRS does not expect you to make money every year. As a business, the IRS is not like, hey, every business has to be profitable. The IRS knows business expenses and setbacks happen. So there's some misconception that you'll hear, well, if you take a loss for so many years, you're automatically considered a hobby. That's not true. That is taking a piece of a larger part of a tax code and applying it in a way that doesn't fit. Sundance 331, you got that giveaway. Congratulations. Okay. So I do want to make a little caveat here as we're talking about, you're very welcome. As we're talking about expenses and setbacks and how the IRS is like, yeah, look, we know you have expenses. There is two words that are vitally important when we talk about expenses that are tax deductible. And those two words are ordinary and necessary. Any expense to your business that is ordinary and necessary can be deducted on your return. Thus, those expenses may lead to the losses that we're talking about. So that's the legitimate use. Anything I say is we're really focused on expenses of being ordinary and necessary. By under no means would I say create fake losses, create things that are not legitimate. So we're talking everything on the up and up legitimate. You can still take losses. But as we've been saying, not all losses are bad losses. And this is where, or not all losses are bad. This is where many people get discouraged. So there's a huge, huge difference. I want to talk about what is a bad loss and what's an investment loss. Two very different concepts when we're talking about business. And most people don't look at it that way. Most people are just like, oh, I lost money, I'm a failure. No, not at all. Let's do an example of a bad loss. So an example of a bad loss. You get a box lot of stuff, whatever the stuff is that you sell, right? You don't look at it. You just so trustworthy. You're like, okay, I'm going to give you $500. You're going to give me a box full of stuff. Well, when you finally get home and you look at the stuff, half of it's not usable, broken, ripped, whatever it may be. That's a lesson. That is a bad loss. That's a bad buy. That is, you've just lost $500. Maybe a little bit less if you can sell some of it. That's a bad loss. That's the kind we want to avoid. But then we have what we would consider an investment loss. An investment loss is the ones that aren't necessarily bad. So think about this. You're just starting out, or maybe you've gone for a while and now you're starting to upgrade. You start putting money to get better lighting, cameras, shelving, packaging, like bubble wrap machines and stuff like that, equipment, software. So you start putting money in for all of these things. That may create a temporary loss, but you're also at the same time building the infrastructure of your business. Very different type of loss than just making bad product purchases, right? So we can't look at, not all losses are equal. We can't look at them all as, oh, this is really terrible. This was a loss of money. Sometimes you may take a loss in a year on taxes, a tax loss, because you're building infrastructure. The first year that we did Whatnot, we purchased a lot of equipment. My husband had a lot of it, but as he started setting it up and starting getting everything configured, he's like, oh, I need this and I need this and I need an extra computer. So we invested a lot in equipment the first year, which led to a loss during that first year. It was a building year. We're getting our footing underneath us. We invested a lot of money in various types of equipment. So we go back to your building infrastructure. That's not bad. Now, Can you just go willy-nilly and be buying all this equipment every single year and never giving it a second thought? I highly would not recommend that. But in certain years, particularly years of startup, years of growth, purchasing a lot and ending up with losses is a very normal, common business occurrence. Think about it like this. I want to give you an analogy. If you've been around me, you know I love my analogies. So a farmer spends money. Think about a farmer. I live in the middle of cornfields, so farming is like fresh on my mind. I had some friends over this week, and at one point we're standing outside. They're like, "What's that smell?" And I'm like, "Oh, it's fertilizer season." And they're like looking at me like, "Okay." So I like farmer analogies. Think about this. The farmer buys seeds, equipment, fertilizer. He's putting all this stuff down on the ground. He's getting ready, getting that crop ready. Where I'm at, it's corn. So starting to get all that corn ready to grow for the season. Nobody looks at him, a couple months later and says, "Wow, that farmer really lost a lot of money this spring. He doesn't have any money." Well, no, because the crop hasn't grown yet. He has to invest and plant and pour into the ground months before he's making any money. Okay? Businesses can be the same way. We can invest and pour into it, taking a loss before we start seeing all of that money coming back to us. So I just want you to keep that in mind. Frequently, people will go through the first year. Where I see this a lot is maybe it's a husband and wife, and one of them, I'm just going to say, I'm not picking on the husbands. We're just pulling it out of thin air for an example. Maybe the husband's like, "Yeah, honey, I'm not so sure about this business." And the wife's like, No, I can do this. I can really make some money at whatnot. Let me show you. And the first year goes by, and you're building some infrastructure, and it turns out to be a loss. And the husband's like, "See, I told you you weren't going to make any money." That's just the first year. That's your situation. It's actually a common situation. It's something that I hear a lot. Don't be discouraged. It is very, very common to be in that situation where you invest in that first year and you're not making money. But hopefully by the end of tonight, you'll have an understanding. Okay, well, what does that look like on my tax return? Kind of what does that mean? You're building. Yes, we're in a building state. Thank you for putting that in there. Many, many sellers will go 1, 2, 3 years before making a profit. Now, you're going to hear people on this app, you're going to hear other chat show people, "I've been on this app for 6 months and I made 6 figures. No, whatever it may be. Good for them. Good for them. That's gross. They're talking about gross, not about net. They're not talking about profit. So you never know at the end of the day if they are really taking a loss or not. All they're showing you is the total sales amount. And any one of us can look at our total sales amount and act like we're, the king or queen of whatnot. It's what happens at the net level of what you're actually taxed on that really matters. So don't let those sellers discourage you. Don't let yourself compare. Thank you so much for your purchase from the bin. Don't let don't let yourself compare yourself to those people, because I can almost guarantee you that there's people with wings and big sellers that are taking losses. It is that common. This is probably one of my biggest hangups is, you scroll through shows and you see shows where they put the thumbnail of their finance page and it has all these, hundreds of thousands of dollars, or they name their shows about how much money they've made, or every time you go into their show, they're like, "I made so much money." Yeah, that's how much your sales were. I made a lot of sales too. It's very tacky, but it's very prevalent. And what happens is newer sellers come on that don't realize the difference between gross revenue and net profit. And they get caught up in this and think they're not as good, or they're not doing as good, or they're bad for their losses that they're having. And that's not true. It gives a very deceiving perception of a financial reality. So let's think. When a minute ago, I said many of the sellers could take 2 or 3 years to make a profit. It's because, think about you. I don't know where you guys are. Throw in the chat what year you're in. Are you in year 1 of whatnot, 2, 3, 4? Where are you on your journey? Most sellers will take a loss those first couple of years. Why? Year 1. Look, we have a lot of year 1s. First year, I'm 2.5 years in. So you're buying a lot of inventory, right? You're buying equipment. Maybe 1.5 years. Maybe you had to go and buy a new iPhone because you realized your Android didn't cut it on whatnot. right? Um, maybe you're learning. Maybe you make some mistakes and you make bad purchases, or you spend money on something that later you realized you didn't need to spend money on because you're learning, because you're testing things out. Maybe you've gone into different categories and you've bought things for different categories and realized that wasn't working for you. Guilty. I made that mistake. You're building systems. You're doing all of these things to create the foundation of your business, and your revenue is slowly growing. Your foundation is being built. Okay. There is still a good chance you can take a loss. You can't get your box muncher. No, you can't. No, you can't. I want to make a really important point here. Growth and profit do not always move together. You can be growing here and your profit coming trailing behind it. Growth and profit do not move at the same time together. When you're expanding your inventory, when you're learning new systems, when you're learning a new skill, when you're testing out categories, you're growing. Okay, you're growing your business. You're growing yourself. That doesn't mean that that profit is going to grow or move at the same rate as your growth. And that's where we start to see some of these losses come in. And that's totally okay. That's how businesses work. And I feel that it's so important to say it. And it sounds like such a simple statement to say, oh, that's how businesses work. But a lot of people come on Whatnot with no business background. They come on Whatnot because they want to sell stuff, not because they have a big business background. So I want to make that point really clear, that just because you're growing, you could be doing all the right things, doesn't necessarily mean that revenue is going to be right in line with that. The revenue, I talked about it this morning, it's a lagging indicator. You do all the right stuff first, and then here comes revenue trailing behind, you know. It's like you're Mama Duck, and Mama Duck's leading it, doing all the stuff, and then here's a little baby duck of revenue finally catching up. That's how it works. So the other side of this, the other thing that confuses a lot of people is cash flow and profit. A lot of you said you've been on here for around a year, 8 months, a year. I can guarantee you're sellers, and you do a show, and then you have some money sitting in your little Whatnot bank, and you say, put that money in my bank account, and you're pulling that money out and pulling that money out after your shows or once a week or whatever schedule you've established for yourself. That's cash flow. We can have cash flow that keeps our business moving. It lets us buy new inventory, lets us buy those boxes. That's not profit. Okay, we can have cash flow all year long to keep the business going and still have a loss. Just because you have cash doesn't mean that on your books you have a profit. You can still end up with a loss. So they're two very different things. And a lot of people will get that confused. They're like, well, I'm pulling money out. I've got money in my bank. If I was taking a loss, I wouldn't be able to buy stuff. Not true at all. And we're going to see why, because on the cash that's coming in, you can have that movement of money in your business, but as soon as it's coming in, it's going back out and getting reinvested into the business, and you can still end up with a loss. Knowing all of that and kind of thinking through, okay, I may be taking a loss the first year or two. This is okay. The IRS isn't going to freak out over my loss, but the IRS does need you to document. Almost every Friday night, something I say is going to come back to documentation one way, shape, or another. And here we are. So the IRS does not accept trust me. Just not in their vocabulary. They don't accept it. Documentation is what you need to turn a legitimate deduction, or to turn a deduction into a legitimate deduction. So it's okay to have losses. Don't let somebody tell you, I'm going to go back to well, if you took a loss for 3 years, you're automatically considered a hobby and not a business. No, you don't know what you're talking about. That's not true at all. So as long as you have the documentation to support your business activities, those losses are not going to get you in trouble with the IRS. This is an area of concern for a lot of people. They're like, oh, it's a red flag, and the IRS is going to audit me because I have a loss, and that's not true. And if they do audit you, it's going to be okay because you're going to have all of your documentation. So what are we talking about documentation? Do I have a list here? Did I actually write a list? I did not write a list. All of your receipts, justification for all of your expenses. So you're keeping that log, you're keeping your books, right? I want you to think, like when the IRS says they don't take trust me, think about if you're driving and you got pulled over, maybe you got a lead foot like I do and you're just going a little too fast, and you get pulled over and that police officer comes up to your window and he says, license and registration, please. And you're like, oh, I have a license. Just trust me. I don't have it on me, but trust me. He's not going to be too happy. That's the same with the IRS and your business. They're not going to be too happy. You got to make sure that you have all of your ducks in a row, all of that documentation. I have a question for you. What is the hardest expense for you guys to track? What is the one thing that you're always like, dang it, I forgot to put that in there again? Mileage. Oh, you hit it. That's mine too. That Dumpster Diva, that is mine. Mileage. Yes. That is where my struggle. So, yep, everybody is like, that's the one that we're like, oh man, you drove for 2 days and you're like, I forgot to write it down. So, there are apps out there. I've used QuickBooks, has an app. If you're a QuickBooks user, their app automatically goes in there. If you guys are using other apps, please feel free to put them in there so we can share with each other and learn from each other. There are a million apps out there to track mileage. And you can also just go old school. You can have some pen and paper sitting in your glove box and just write it down. The Stride app will automatically track when you're driving, and then you just delete the non-business trips. I love that. That makes it easy. Yes, MapQuest. I don't even know if half the people know what MapQuest is anymore. I told my son the other day, I'm like, let's just MapQuest that. And he's like, looked at me like, what are you talking about? All right. When we're talking, is it too late to start keeping track? It's mid-year. Not at all. It is never too late. It is never too late to start keeping track. The Pinster, let me read it. The Spinster's Cupboard. The best thing you need to do is you're like, okay, I haven't been keeping track. You've identified the problem. Now you're going to fix the problem. So from right now, what are we? June 5th. Right now, you're going to start keeping track. And then, so you're going to change, you're going to do it right. Then you're going to schedule time to get caught up for the first 6 months. And by the end of the year, you should be on board. I had to use Google Maps and look at my history to see how many trips. Yeah. Another thing, you keep your receipts. If you ever miss mileage, you can look back at your receipts. It's a way to recreate. I don't suggest recreating mileage. The IRS doesn't like that. But if you haven't been doing it, to recreate just to get caught up to speed is totally okay. You're probably not going to claim all the mileage that you could have claimed had you been doing it properly from the beginning. But using Google Maps, using all of the times if you actually get a receipt from the post office and counting those up and knowing how far your post office is. You don't have receipts from getting inventory. Now that's a hard one. What I would do if I were you is recreate that as much as possible. So if you used a bank account, like a debit card or a credit card, you can use those statements to recreate. If you've paid cash, you could estimate very conservatively based on the cash withdrawals from ATMs, on how much cash you spent on inventory, and then write that down. So if you have to recreate, what you recreate in the most conservative way. So if you're thinking, I probably spent $1,000 in cash, I would say, let's be safe and say it's $500. You're going to go less. You're going to lose some of your deductions, but that's the price to pay for not doing it right to begin with. I have the receipts, but it doesn't say what the item is. That's okay. That's totally okay if it doesn't say what the item is. You do not have to keep your inventory item by item by item. There's 4 things you need for inventory to recreate your inventory. So if you're trying to look from January 1st to June 5th, what did you start with? If you just started this year, your inventory was 0 to start. If you didn't start this year, then you go look at your last year's tax return, your 2025 tax return, and there's an ending inventory number on there. You use that. So what's the starting? How much came in? So add all those receipts together. How much came in? How much went out? What did you sell? And what's left? The hard one is what's sold. If you haven't been keeping records, you probably don't know what's sold. But if you know what you started with, plus what you bought, and you know what your ending is, you should be able to go into your inventory room, storage area, wherever you keep your stuff, and look and say, add up all the stuff and say, okay, I have $300 of inventory sitting here. So then if you take your starting plus what you bought and minus what you have, you're going to get how much went out. Just buying inventory. All right, so you have nothing have gone out yet. It's even made it easier for you. So you only have 2 numbers to worry about at the moment. So you're in even a better position. I want you to think about these receipts, the mileage. Mileage isn't technically a receipt. It's just the hardest thing to track. But all these receipts we're talking about, like, hey, I didn't keep the receipt. And I know I do this. I could, like, maybe run to the antique mall, buy just one thing. Maybe it's $20 and I lose the receipt and I'm like, just forget it. I lost the receipt, whatever. Oh, do you need an LLC? I'm going to S proprietorship. Nope. I'll tell you about that in 1 second. So you get you say, I'll forget the $20 receipt. And that's today. Maybe next week it's another $20 and then another $15 receipt, then another 12 or a 40. All of those little purchases can add up to hundreds or thousands of dollars of missed deductions at the end of the year. They add up super, super quick. So we do want to be diligent. I've lost a lot of weight, but the clothes that I'd like to sell, there's no way I can document how much I paid for them. The Spinster's Cupboard, I'm going to answer your questions a little more in depth. I'm going to answer Sundance first because it's a little quicker. What you need to do is to conservatively estimate. If there is absolutely no way that you're like, I have no clue how much I paid for this pair of jeans, use thrift store value. So whatever the local thrift store would charge for a pair of jeans, that's the value you're going to assign to that item. Is it lower than what you paid? Probably 100% it's lower. But that's a number that you can justify to the IRS if you were to be audited. It's a very conservative number. Pro Pass, rating with a party of 2.
Welcome in, Raiders. Glad you can join us on this business and tax discussion.
Thank you so much for bringing your friends over. We are talking taxes tonight and how to use losses strategically. My name's Tracy. This is Zoe's Treasures. ProPass, please take a minute, put in the chat what you do, who you are, when your next show is, what you sell, all that good stuff so that anybody who likes it can go ahead and give you a follow. And thank you for coming on over to the show. We'll start another giveaway. We are doing CEO affirmation cards for our giveaway. Okay, Cajun Love, would I combine my regular work with 1099? Yes, Cajun Love, I'm going to talk about that. I have another question right in front of you first, and then we'll talk about that. All right, so somebody asked, do I need to create an LLC or a sole proprietorship? Here's the thing. The minute you go into business, you are a sole proprietorship immediately. You're considered a sole proprietor, okay? That's just automatic. There are reasons to and reasons not to create an LLC. You are going to hear people tell you, oh, go get an LLC. It protects your assets. Get an LLC. You have tax advantages. Does it protect some assets? Yes. Is there tax advantages to an LLC? Not really. If it is just you, a single member LLC, you file the exact same tax return as you do when you're a sole proprietor. There is no difference. Okay. So, when you're thinking about getting an LLC, I would suggest you talk to a CPA and an attorney. There is a whole bunch of different type of variables that go into that decision, and it's not the same decision for everybody. Some of the things they are going to ask you to determine if it makes sense for you is they're going to ask for financials. What's your financial position? What have you done so far? They're going to ask for projections. What are you estimating your business to do in the future? Whether you have partners, whether you ever will have partners, how much control of the business you want. They're going to ask about, do you have employees? They're going to ask about what personal assets you own, what business assets you own, what assets you plan to own. They're going to ask you, are you doing something that's highly liable type of business? Are you doing something that you're really likely to get sued in or not? I sell vintage decor. The odds of me getting sued are very, very low. So it's not a one size fit all that, oh, I'm in business, I need an LLC. Oh, y'all, just the Raider promotes, please. So just the Raider has rights to promote. So it's not a one size fits all for an LLC. So you need to think about all of those types of things that I just said, and there's probably more. But before you get an LLC, because you are creating a separate legal entity, meet with an attorney and a CPA so they can advise you and help you think through all of these variables to see if it really makes sense for you. Okay, hopefully that answered that question. Please ask more if you have any other questions on it. Just put them in the chat. I'm always happy to keep trying to answer it. You're an MA and an LLC is $500. It is. An LLC is a completely separate entity created within the state that you live in. Like you said, you're in MA. Is that Maine? Is MA Maine? Massachusetts? I never know my M's. There's too many M's. I think it's Maine. Massachusetts. Okay, I was close. Massachusetts. So you have to pay annual fees, registration fees. You have to usually file some type of annual report. You usually have to do some type of minutes from your board meeting. You have to make sure that you are keeping everything separate for the business. And if you don't do any of those things, you open yourself up for all your personal assets can be sued anyways. You pierce the corporate veil that protects you. So it is very important if you're going to do an LLC that you really fully understand the implications of it, because it comes with a lot of responsibility. If you decide that you don't want to be in your business and you have an LLC, you have to dissolve that entity. You have to file additional paperwork to make that entity go away. Whereas as a sole proprietor, if I decide I'm out of business, done, see you later, I don't have to do anything else. What if I really just want to have fun thrift shopping and will make less than $10K a year? This is way more complicated than I wanted. The Spencer's Cupboard. Even if you make less than $10K a year, you are still considered a sole proprietor and must file a Schedule C tax return. The limit for filing a tax return for reporting your income on your tax return is $400. You're going to hear people say 600. They are completely incorrect. It is not 600. It is 400, because 400 is when the self-employment tax kicks in. So you have to file that Schedule C. And it really isn't that complicated. There's a few things you have to track: your inventory, your income, and your expenses. As long as you're keeping track of those, you should be okay. It feels complicated. If you've never done it before, it can sound a little overwhelming, but if we break it down and just take it step by step, it really isn't. It's as much as this is as easy as it could be. You get a notebook like this, just old school wire-bound notebook, and a pen. You write revenue on the top of one page. Every time you earn money, you write the date, what you earned, and what you sold. Dumpster Diva, that is for you, that giveaway. Congratulations. Thank you for being here. And then on the next page, you write shipping expense and maybe, inventory and all the different types of expenses. And then you just note it down every time you spend money. That's as simple as you can make it and still be totally compliant. Is it going to be fancy and give you all these reports? Probably not, but you're going to have the records you need. Expense inventory. What else? What I would suggest is, I will bring up a Schedule C in a little bit. My husband can actually bring it up. I would suggest using your Schedule C as a starting point for the categories they have on there, and those are the categories that you're going to track. We'll do that in just a second. There was another question I want to address. There was a 1099 W-2 question, and I'm making sure I'm not missing anything else. Real quick though, Tabitha says, don't expect to wait on a 1099 either. Most apps won't send one until you make 20K, but they report every penny to the IRS. They do not report every penny to the IRS, actually, Tabitha. So the rule for 1099, since we're getting on that topic here, for 2025, every app, Whatnot, PayPal, Etsy, all of those apps were required to send you a 1099 and report it to the IRS if you made 20,000 in sales and had 200 transactions. That was a threshold at which they are required as a company to report the income. If you made less than 20,000, they didn't report that to the IRS. That doesn't mean that you don't have to. It just means that they don't have to. It reduces the administrative burden on them. All that is a threshold where they have to send you something, and also then all of the 1099s they send out, it's all done electronically, but all the 1099s are added up. They go on another form, I think it's called a 1096, and that is what Whatnot submits to the IRS. Five Alarm says, I got an LLC because I was told I needed one. I have not sold anything yet. Should I dissolve it now? If you have done zero business in there, I would still talk to a CPA or an attorney, because it really depends on all the other factors that go into it. If any of those other factors apply to you, there may be reasons why you want to. There's another really big reason, and it's really popular on here, that I'm going to tell you about when an LLC makes sense. But I want to just answer this other question first. So the person who asked for the 1099 and the W-2, you file all one tax return. Your W-2 income goes on your 1040. Your 1099 goes on your Schedule C. That's still the same tax return. If you take a loss on your 1099 income, your Schedule C, you can offset your W-2 income with the Schedule C loss, but it all goes on the same tax return. I hope I answered that right, but you do claim all that same revenue all on the same tax return. All right. We're going to talk about the very unique LLC situation that I see very frequently on Whatnot. Since Whatnot issues us the postage label, is our shipping cost just boxes, tape, and paper, or do we have to account for it? You only have to account for shipping expenses that you pay. So what I mean is, if you do reduced shipping and you absorb any of those shipping costs, you pay that. When you're doing your shipping and you hit adjustments and you go over your 5 and you have to pay for some, that's deductible. So only shipping expenses that you actually pay for. Do I need to file sole proprietorship if I use, so if you're a sole proprietor, you do use a Schedule C. So sole proprietor just means me, Tracy, went into business. I haven't filed any other legal entity. The Schedule C is the form I use to report that to the IRS. That Schedule C gets attached to your 1040, which is your personal tax return. I will be offering too, I have not rolled it out yet because we're not quite in tax season, but one of the services I am going to be offering at the year end is Schedule C tax prep, not preparing it, but review to make sure that you have everything in order and ready to file your Schedule C. Then during tax season, I will not be doing taxes, but I will be offering a service where if you send me your Schedule C, I will review it and point out things that you may have missed or that you want to fix. So that is coming.
Only for you, the bird theory.
Just for you, the bird theory. Can I explain the items in my store? Absolutely. Let me pin them up. I'll go through them really quick. So this is one of my favorites. This is an easy one. These are our CEO affirmation cards. Let me grab over here. So on Friday mornings, I do a business show, and then we do Tax Tonight. It's our live seller collection. So we have a deck of cards that have CEO affirmations, 52 cards. That's what that one is. But then the really fun stuff, the Spinster's Cupboard, I see your question, we'll get to it, is some of these ones here. This is the new service that I'm offering. This is the Live Seller CEO report. This is a 1-month review where you provide me with some of your analytics, some other information that I will give you. And if you click on the pictures, it kind of really details it out. And then I give you a 6 to 8 page detailed report, kind of digging into your business and saying, here's what all of your numbers mean. Here's are some things you may want to look at. Here's some stuff you're doing really well. I do the same thing for the quarterly review, which is this one here is the quarterly review. This one's a little more in depth. This is about a 12-page report, and I start to look at trends for your quarter. So I take all of your numbers and help you really understand them, digest them, figure out what they mean for your business. So those are 2 services that I offer. And then we have these guides. There are 31 either 31 Excel templates or informational guides on a variety of topics. If you click on the pictures, you'll see a list of all the topics, and those can be purchased individually, or you can buy access to the whole library, lifetime access to what's there now and anything I ever put in to it. And those guides cover a variety of topics. There is a picture in there that kind of details every single one that's currently in there. I don't see where it is. All right, maybe you can pin it while I answer the question. So let's go back up to these questions. I hope that answered your question. That's the bulk of what I have in there. If there's any specific one you have a question on, I'm always happy to answer. Just put it in there. The Spinsters, first time here, can you say, we got that. The Spinsters Cupboard says, so I can find my normal tax stuff, including a Schedule C, even if I haven't technically applied for, you don't have to apply for it. You're a sole proprietor. The minute you hit go live and you sell something, you're a sole proprietor. You don't have to apply for it. It's not a legal entity. It's just you. So the minute you start doing business, then you're just automatically it. It's like somebody tapped you on the head with a wand. Crexlover, I hope I'm saying that right. In my state, resellers can get a tax exemption certificate. Can I do that as a sole proprietor? Do I need to use EIN or just SSN? Yes, you can. You can get that as a sole proprietor. So, and you're right, it is state specific. So to get a tax exempt or a reseller's certificate, which will allows you not to pay sales tax because you're the middleman, and it kind of pushes that sales tax to the end customer. You just go to your state website and you apply for it. You can do it with your social security number. If you're like, hey, I don't like that, I'm very protective of my social security number, there is nothing stopping you from applying for an EIN and using that too. So it is your preference. Let's see. Cajun Lover, would it be a good idea to at least have an occupational business license and pay the taxes quarterly? And would it be state and federal? So I don't think you need an occupational business license of any sort unless your state or locality requires it. Most do not. Just to resell on whatnot, most do not require an occupational license. Again, double check with your state. You can always go to your state website and find out. I focus mainly on federal because there's no way I can know every single state law to advise on every single state. In general, state taxes follow federal taxes for the most part. But as far as occupational business license, unless there's a requirement for your locality or your state, it's not necessary. Now, paying taxes quarterly, you're talking about estimated taxes. Estimated taxes, it depends. Famous accountant answer right there. It depends. You may or you may not have to pay estimated taxes, and that applies to every single seller that has ever sold anything. The way you figure, the easiest way, I do have a PDF in there, a guide that really details estimated taxes. It's called Understanding or All About Estimated Taxes, and it's going to give you examples. I'll tell you very kind of high level. If you expect to have a tax liability of $1,000 or more than what you had last year, then you should be paying estimated taxes, either by writing a check quarterly or by increasing if you're a W-2 employee, what's being taken out of your paycheck. That's the most simplest explanation of estimated taxes. It can get more in depth, but if you take your tax return last year, there is a line that says tax liability, not what you owe, not what your refund was, tax liability. You look at that line. If it says your tax liability was $5,000, and this year you sit here and you do some projections. You're like, all right, I'm halfway through the year. This is how much I've made. I'm going to keep doing things the same. I expect to make this much. I really think my tax liability is going to be $7,000. You need to pay something in order to avoid penalties at the end of the year. That's a very simple explanation. I do have more in depth where I've talked more about estimated taxes on my YouTube channel. All of our shows go to YouTube, so you can always go back and rewatch. And if you want, I'm always happy to answer questions. You can always DM me, and I will try to answer any question you may have. And you can try to put them in here too. If you're like, hey, I just don't understand. What do you mean by this? Always happy. Because if maybe you have a question about it, I'm sure somebody else does too in the room. It usually works that way. Same name. Yep, YouTube is the same name, Zoe's Treasures. We'll throw it on the screen for you. And I told somebody, I mentioned to somebody earlier, I think it's a Spencer's Cupboard, that we would pull up a Schedule C. Are you ready with that? Or should we wait? Okay, let's go ahead and pull up. Thank you so much. I appreciate that. Let's pull up a Schedule C. If you are not already like keeping track of stuff and you're like, I don't even know what categories to use or how to organize my expenses, the easiest way is to use the same categories that's on your Schedule C. That way you're doing your accounting the same way you're going to end up transferring it to your tax return. I'm waiting. He'll pull it up here in a second. He had to get it set. All right. So if we zoom in on part 2 there a little bit, it says expenses. So lines 8 all the way through, 30, I think? I would use those same type of categories, or 27, if they apply to you. So car and truck expenses, you keep your mileage. Commissions and fees. So all the fees that you pay, whatnot. I wouldn't worry about depletion. Contract labor is only if you're paying somebody else to do shipping or something like that. If you're not paying, employee type stuff, you can just skip over that. And a lot of you, if you're just starting, keep it simple. But you do look at insurance. If you maybe have a storage unit and you have some type of rental insurance on that storage unit, you can deduct that. Legal and professional services. When you go and talk to your CPA, when you go and talk to an attorney, that's all deductible as long as that is you're talking about business, right? When you're trying to figure out, should I set up this LLC, and you go and you have to pay a little bit to get some advice, that's deductible. Let's scroll over to the other side. I would keep office expenses, paper, pens, all those miscellaneous things that you need to run a business. Even if it's a business online, you're still going to buy some paper and pens. Pension and profit sharing, if you're just starting, you're probably not into that yet. If you rent or lease anything, if you have to rent a piece of machinery, if you need to rent a computer, if you lease a storage unit, any of that stuff you would put in there. Repairs and maintenance. If you crack your iPhone screen and you got to go get it fixed, that's a repair. So you might want to track repairs and maintenance. Supplies not included above. So shipping boxes, envelopes, bubble wrap, packing paper, all that stuff you're going to put in there. Taxes and licenses. So this is any taxes and licenses you have to pay, and our other fees, such as somebody mentioned they have to pay $500 a year for their LLC. You can put it under that line. Then you have travel and meals. If you have to travel for your business, keep track of all those travel expenses, airlines, hotel, parking fees, all of that, and you can deduct that. Meals are 50% of what you paid. Utilities. So you want to keep, if maybe you have a separate building of some sort and you have utilities going in there, portions of your internet, sometimes for your home office, it's included under home office, but you want to think about your electric, wages if you're paying somebody. A lot of people are not paying somebody right off the get-go. And then anything else that is an expense. What do we go back to expenses? Thank you so much. But you can go to IRS and Google Schedule C and come up with that list right there. And now you have like a starting point of what do I need to track? Any other expenses. So when I say other expenses, what do I mean? If it is ordinary and necessary for your business, keep track of it. Ordinary and necessary. Those are two words that the IRS uses over and over and over again. And this is why you will hear some sellers say, well, my CPA said that I can do this and I can write this off. Well, maybe for your business, it's ordinary and necessary. For mine, it may not be. That's how we can have two different businesses and something can be deductible for one and not for another business. The example I love to use all the time because it's so visual type of an example. A race car driver, Dale Earnhardt, can write off a motor for a car. He can write off brake pads. That's ordinary and necessary to be a race car driver. He can write off a helmet. He can write off the jumpsuit, the fire suit that he has to wear when he's driving. You as a whatnot seller can't write off your brake pads, can't write off an engine for your car if you're selling vintage decor. It's not ordinary and necessary in the line of your business. So when you're thinking about what receipts do I need to keep, just remember those two words. If it's ordinary and necessary in order to make money or do the administrative part of your business, you can deduct it for the most part. All right. Let's keep going here. Strategy beats shame. Overall, we are talking about, my Alexa's just going crazy over there, starting talking to me. Overall, we're talking about how to use business losses strategically. Most of us take a loss in the first few years. Tabitha, thank you so much. I appreciate that you said that. I think they're pretty okay. They're not super fancy. I try not to include way too many formulas because then they just break and people get frustrated. But thank you very much. So strategy beats shame. If you have a loss in your first few years, heck, even if you're 10 years into this and you have a loss in business, it's okay. It happens. Losses happen.
Thank you.
Don't look at it as information. A loss is information. Okay? A loss is not an identity. Because your business took a loss doesn't mean you're a bad person, doesn't mean you're a failure. So don't think, oh, I'm bad at this, or, oh, I shouldn't tell anybody I took a loss. I don't think we need to be broadcasting all our information out there, but you don't have to be ashamed of it. You don't have to hide the fact that you took a loss. Businesses take losses. Big, huge, famous corporations take losses. So don't feel bad. Don't be ashamed. And don't feel that, oh, everybody else is succeeding and I'm not. Because they probably are in the same boat as you are, to be honest with you. I have seen enough tax returns. I've done enough bookkeeping in my life. Everybody's not as good off as they tend to portray. So be happy with your growth. Look at what your successes are. Don't feel shame, bad, or anything else if your business is taking a loss. It is not you personally. It is a business problem. And here's what the coolest thing about business problems. Business problems can be fixed. So a loss is something didn't go right in your business. We identify it and we fix it. It's easy. Okay. So what you want to look at, instead of saying, why did I fail? What is it that's causing this to happen and how can I fix it? That's all it is. It's not anything other than that. And it's very hard because at the beginning of the show, I said, when you hear the words loss, how does it make you feel? And a lot of people think profit is success, loss is failure. Just erase that. It's not true. Okay. I want to give you an example. Let's say you lost money because you overbought inventory. You bought too much inventory. You underpriced your items. You were just starting out. You're like, I'm going to do everything at, I don't know, $3, and it wasn't working for you, and everything was selling for $3. You just didn't price your stuff correctly. Okay. You were learning. Or maybe you did reduce shipping before you were ready to do reduced shipping, and it cost you a lot of money. Those are business problems. Those are going to create losses, but they can be fixed. Business problems have solutions. You can pinpoint what it is and you can fix it. It's nothing to be embarrassed about. It's a learning opportunity. All of us, every single person on this app has made a mistake. Every single person has taken a loss on something. Every single reseller has made a stupid purchase that 6 months later, they're like, why did I buy that? Nobody wants it. I can't sell it for nothing. It happens to all of us. Question. Let's share some encouragement with each other. What is one lesson that you learned from a mistake that actually made you a better seller? I'll tell you mine. Mine was buying outside my inventory lane. Mine was when I was a new seller, I got on raid trains because everybody says, get on raid trains, get on raid trains. And I thought they were cool. And I thought that was the way to success. And so I got on raid trains that had nothing to do with what I sold. And I bought a lot of inventory for those raid trains. And I got stuck with a lot of stuff that I couldn't sell. That was a lesson I learned that has made me a better seller today. What about you guys? Do you have any examples of like, you know what, I learned this and it's made me better? So Callie says, no reduced shipping until you're making 100K or more. So that's a lesson you learned. Cajun, you don't like raid trains. I never do good on those. I never make a lot of money on raid trains. And have become very selective in my raid trains now. It's not something I do. I do 1 or 2 a month max. I used to try to get on them a lot more than that. I don't anymore. I learned by not being pressured in selling something, standing true to yourself. I love that. Being confident in the way that you've priced something or the way that you've presented something. You make the decisions, not the people in your room about how you're selling. So I absolutely love that one. I find new buyers on trains, but make more money at my shows. 100%. That's what I think trains are good for. Trains are good to get in front of other audiences that may not find you in another way. I do not keep sourcing buying unless I have a certain dollar of sales under your belt. So you have some financial boundaries around your sourcing. I'm huge on sourcing boundaries, you guys. You're going to hear this. If you come to my shows more and more, you're going to hear me talking about sourcing boundaries. Your money is made when you source, so you should have rules about how you source. They don't have to be written down. They don't have to be carried around on a piece of paper. But in your head, you should have some rules. My kind of general rules are, will it fit in a 12 by 12 by 12 box? I don't want to have something super big. That's a rule I do occasionally break, but that's really one of my rules. I do dollar start. So everything I look at, I say, looking at the price of the item, could I start this at $1 and still make money on it? That's a rule for me. And then my third rule that I look at, is this in line with the products that I sell? Does it fit one of the aesthetics in the shows that I do? If it's a no, I don't buy it because it doesn't fit me or my brand. Biggest mistake, never kept track of inventory. And I bet you kind of got to a tax return and you were like, oh, I didn't do that. So we learn. You know what? Every single one of these things is a business problem. Business problems have solutions. And I can guarantee you, we've all heard these things. Go and Google whoever your favorite sports person is, or favorite author, or favorite movie star, and really read about their backstory. Every person that you see is really big has failures in their past, has losses, has mistakes in their past. This is how they get to where they are. Haven't kept track of injury, how to move forward. Okay, so how do you move forward? Have you sold it all this year? If you have not sold it all, you're great. You just need to recreate. You need to go and look at your bank statements. You have sold this year. All right. So did you sell last year? Did you sell in 2025? For those of you who are like, I haven't tracked my inventory. Did you sell in 2025? We have one yes. If you sold in 2025, okay, at a brick and mortar. So same business, the Spencer's Cupboard, same business, or two different businesses? I'm assuming same business, that you're just taking your brick and mortar inventory and moving to whatnot. Okay. If you sold in 2025, somebody did your taxes, your accountant estimated inventory. They probably did the best they could with what you had. Take your 2025 tax return. That's your starting point. Okay. That's your starting point in 2025. That's your, what am I starting my inventory? Then you add in what you bought. If you didn't keep receipts, you have to go and recreate it the best you can. Bank statements, credit card statements, cash withdrawals that you know that you went to garage sales with. So go and recreate the best you can. That's what you put into it. Starting point, what your additions were. Forget what you sold. Don't worry about that right now. Go and look what you have right this minute. Go into your inventory and estimate the value of the inventory that you have to the best of your ability. That's your ending inventory. Now you've got the making to start moving forward and recording your inventory correctly. I sell vintage jewelry, which I have been collecting for over 50 years. I'm now selling. How do I determine your original cost? Okay, so if you, yours is a little more difficult. It's more of a collection. Estimate the original cost the best you can for as many pieces as you can. If you can look at, certain pieces that maybe there is some sentimental thing that you knew you got it in a certain place and you paid a certain dollar, recreate the best of your ability. For everything else that you're like, I don't know, I got it at JCPenney's 20 years ago. For all of that stuff that you just don't know the price, what would you pay for it at a thrift store? No, it's cost. You estimate cost. So, and we're using a thrift store sales price only because that's the closest thing we can get to as a value to put on the item. It's going to be lower than what you paid probably 9 times out of 10. But in lack of having any receipts, that's what you're going to have to do. So you estimate the best you can, being extremely conservative. Because why you want to be conservative, if you are ever to be audited, and only just a small percentage of people get audited, do not let that get in your head and be fearful of that. If you ever were to be audited, you want to have a reasonable way to show the IRS on how you came up with the cost on those items. And the lower your cost is on those items, the more conservative you are, the more forgiving they're going to be. I didn't think to file last year regarding business, how to fix that. If you sold in 2025 and you made more than $400, you should technically file an amended return. So you just need to amend your tax return, your 1040, and add on that Schedule C. Now, we start getting into cost benefit here. So the correct legal technical answer per the IRS is file an amended return. If you go to a CPA and pay them, amended return, 1040 Schedule C. However, if you go to a CPA and pay them for this, they're going to ask you, how much money did you make? What was your net profit? Okay, because we're talking net, we're not talking gross. Two different things, not the money, not the sales, but after you deduct all your expenses, what's your net? If your net is less than $400, probably you don't even need to do it. I would just say skip it, don't worry about it. $500, technically you need to pay self-employment taxes. At that point, you're stealing from the IRS. But how much? Are we talking you owe the IRS $50? Do you want to pay $300 for an amended return because you owe $50? What's the cost benefit? It depends what your tolerance for risk is. I'm not telling you not to file an amended return, but I'm telling you there's a little bit of trade-off there, and a CPA will help walk you through that. So there you go. You're on the right track. Sold in 2025, but did not take any whatnot money out until 2026. Doesn't matter. You still made the money. You earned it. Can I deduct what I spent last year on inventory and expenses? No. No. What happened in 2025 stays in 2025. What happens in 2026 stays in 2026. Kind of like Vegas. So if you did not, and it doesn't matter if you take money out of whatnot. When you make money and you go to your whatnot finances and it shows that you have money, that's your money. You earned that money. In the eyes of the IRS, in the eyes of bookkeeping, that's your money. It's just sitting with whatnot, waiting for you to take it out. You still earned it. So it's income in the year that you earned it. And that's a case where, again, do the same type of thing that I was just talking about. Think about an amended return for 2025. Look at that cost benefit. Talk to a CPA or a tax preparer. It does not have to be a CPA. I'll tell you what, I've said this a lot. There is at H&R Block, and I know they get a bad rap, but I used to work there as a CPA at night. I worked as a CFO in nonprofit for many years, and during tax season, in one tax season, I worked there for a couple years, but in one tax season, I worked at H&R Block as a CPA doing higher level advanced taxes for customers and made enough money in 1 year for a down payment on my house. So then the next 2 or 3 years, I kept doing it because it was a good way to get a big chunk of money as a CPA. The whole reason I tell you this is there are very educated and smart people at H&R Block. I know they get a bad rap, but they can help you for a lot less than if you go to a CPA firm. It's going to be like half the cost of what you're going to pay at a CPA firm. And you took a loss, so you should be good. Now, if you took a loss, it depends on what other income. Maybe you're due a refund. You don't get a refund just because you have a loss, but maybe if you have W-2, if you guys purchased anything, please check your DMs. My husband's trying to process it in the background to get everything to you as fast as possible. If you took a loss and it offset some W-2 income, there's a possibility of an additional refund amount. I don't know your situation. I'm just saying there is a possibility. As a CPA, that would be one of the things I would look into. Where can the percentage for self-employment taxes? Okay, so Cajun Lover, there is no set percentage. You're saying self-employment, not estimated. Okay, let's go back. So self-employment taxes are 15.7, you're testing my knowledge, about 15%. Basically, self-employment taxes, you got to think of them like this. When you work for somebody else, your employer, when you get a W-2, you get your paychecks, okay, throughout the year. They do federal withholding, Social Security, and Medicare. Social Security and Medicare. You pay 7.3, 7.25, somewhere in there of your Social Security, Medicare. Your employer pays the other half of that for you. That's a benefit for you as an employee working for somebody else. Well, when we're self-employed, guess what? We pay that whole 15% ourselves. Now, the IRS gives us a small little deduction off of that, so it actually drops it down under the 15% a little bit, but it's around the 15% mark. If any tax software that you're using on your own will calculate that out. If you're doing a Schedule C, if you're just like downloading it and you're filling it out like, hey, I just want to understand this, you can go to the IRS, www.irs.gov, and Google self-employment tax, and they have a whole publication on it too that'll break it down and all the percentages for you. Your jewelry collection, if I pay $20 for something years ago and I sell it for $300, how do I handle? Your cost of goods then is $20 and you have a $280 profit. That's how that is. So your cost of goods, what you deduct as the expenses, what you paid for it, the rest of it from your sales is your profit. Hello, CG. All right, I'm going to keep watching. If there's any more questions, feel free to put them in there. We were talking about when you lose money at the very beginning. If you lose money because you overbought on inventory, all this stuff, those are business problems. Business problems can be fixed. We talked about lessons learned. Let's talk about planning. Planning avoids misuse. This is where the IRS stuff comes in and becomes super, super important. The IRS expects businesses to operate with a profit motive. Is there a good way to keep inventory and use it to post on other apps like Etsy? Yes, there are inventory programs out there, but when you're talking about being able to cross list, that's like posting it in multiple places, like putting it in one system and then hitting buttons so it goes to all the different stuff. I recommend Vendoo. There are other apps. I haven't used them. What I personally have used is Vendoo. I'm not affiliated with them. It's just something that I have experience with. I felt it worked really well. Vendoo. That is a cross-listing app. There is a cost for all of those. There is another one too, and for the life of me, I can't think of it. Somebody was telling me about it the other day. Cross something. It's called Cross something. No, I can't think of it. If you Google cross-listing apps, more of them will come up. Vendoo is just one of the more popular ones. Shopify integrates with Whatnot, but Shopify isn't necessarily a cross-listing app. I don't know if Shopify integrates with Etsy and if it updates. Like if you sell something on Etsy, does it update Shopify and Whatnot? On Vendoo, if you start in Vendoo, you put the item in and then you click the buttons and say, okay, post this on Whatnot, post this on Etsy, post this on eBay. And then somebody on eBay buys that item, and Vendoo will then automatically pull it out of Whatnot, pull it out of Etsy as sold items so that you don't double sell the item. So that's behind the scenes built into Vendoo. It'll post everywhere and it'll pull it out once it sells, depending on what app it sells on. And it also goes to a whole bunch of apps. So it connects to like 10 or so different platforms. But that's the only one I can even speak on from personal use. There are more out there, and there are other ones that are really good. List Perfectly, thank you. That's what I was trying to think of. Somebody was telling me about that. Somebody was telling, who was it? Crystal's Vintage Collection, I think, was telling me that they really liked List Perfectly. That is another one, works similar to Vendoo. Tinkerbell, thank you for bringing everybody over here. Thank you for that raid.
Welcome in, Raiders. Glad you can join us on this business and tax discussion.
You are very welcome. And Tinkerbell, thank you so much, y'all. My name's Tracy. This is Zoe's Treasures. We are doing a tax talk. We're talking about using your losses, your business losses strategically. We're talking about what that means, all the implications. Tinkerbell, please, please, please put all of your details in the chat. Only the Raider can promote it this time. So this is just for Tinkerbell. Can you please put in who you are, what you do, what you sell, when your next show is, anything you want to tell us about yourself so that people can learn all about you and follow you if they like what they read. You are very welcome to Spinster's Cupboard anytime. And you guys, I've got a few more things to talk about, but if you want to DM me questions too, I'm always open for DMs. Does Whatnot allow us to use cross-listing apps? They do. Yeah, Whatnot does. So Whatnot integrates with Vendoo, and I don't know if they what's the other one? List Perfectly. Who said they use that? Thrifty. If you use List Perfectly, if you know if it integrates with Whatnot, please put it in there. Yes, it does. Thank you so much. So it does integrate. Whatnot is slowly, we've only been around 4 or 5 years, right? Okay, hello, Daisy Lane. So Whatnot's been around 4 or 5 years. I can only see that there's going to be more and more apps that start to integrate with Whatnot. It's still a baby. It's still trying to get out there, right? Would it be a good idea to withhold around 25 to 30% of each payout to cover all taxes when filing, or should it be more? So Cajun Love, depends. Do you do this full time? Is this all your income is Whatnot, or do you also have a W-2 income? That would make the difference on how much you would withhold. So if you want to put that in there, I can give you a little bit of a general number. There is nothing called List Perfectly in the Apple Store. You may have to Google it. I've never used it, but so you may, and I think it's all together as one word. So for Cajun Love's question, W-2 income as well. Okay. So this is just a general, there it is right there. My husband pulled it up, List Perfectly. So it is two different words, sorry. I've never used it. I'm not affiliated with them. We're just throwing out ideas here. Okay. For your money to put away for taxes, this is a very general advice, okay? Thank you, honey. I'm sorry, he's giving me a note here. I'm trying to recognize something on the screen. If you have W-2 income, you probably want to withhold about 18% of your net profit for taxes. Why 18%? In general, you're going to owe between 15 and 20%. That's if you have a W-2 income. So I'm just hitting that middle ground. Does it mean that you're never going to owe anything at the end of the year? No, I can't guarantee that. It's just a general number to start to put some money away. If you, Whatnot is your full-time thing, this is all you do, there's no other income, you're not looking at anything else, then you're looking at about 27%. Then you're up there in the higher amounts because you have no other taxes being paid in. Well, it's just a web-based, there's no app. Okay, that makes sense. So that's kind of what you want to look at. We're going here is to estimated taxes. I do go through examples, really detailed examples on how to figure that out. I do have a guide in there. If you want to figure it out for free, the best place to get the free information, a lot of what the information I have is pulled out of IRS guides, but you can always go to www.irs.gov. It's the IRS website. There's a search bar. You can type in estimated taxes, and they have a whole publication that'll pop right up there at the top. And that will tell you everything you need to know about those percentages, how to figure them out, different ways to look at it. You haven't started selling it, but hopefully will become full-time. Well, that's wonderful. And I'm really glad that you're thinking about these things ahead of time. Many, many sellers do not think about taxes and bookkeeping and systems and organization before they start selling. They end up selling, do nothing, come tax time, and have the shock of their life. And that's why I'm here trying to prevent that from happening as best I can. So earlier I said the IRS does not expect, hello, crystals. The IRS does not expect every business to be profitable every year. So it is not a red flag. Taking a loss on your Schedule C is not a red flag. Taking a loss 3 or 4 years in a row is not a red flag. They may look at it, the computer system. It's not, in the old days, like I'm talking like 30 years ago, it was a real person, an IRS agent would look at every tax return. They would there'd be certain income thresholds where they would say some they don't even look at, other ones they would look at certain numbers. We have AI now. It's all computerized. So would I venture to say that maybe there's going to be more inquiries from the IRS due to AI and the technology being able to, process everything faster and really dig into numbers? Probably. But it's still okay to take losses. The thing is, when I go back to what I said earlier, make sure you have your documentation so you can support that. There's the whole thing that you're going to hear about. You'll hear other people quote this incorrectly, and it drives me freaking insane. Is, oh, if you take losses, you're a hobby. You can't do that. Then you're going to get audited. That is not true. You are a business. What the IRS looks at is intent to make a profit. As long as you're documenting your intent to make a profit, you could substantiate any claim that that's a Schedule C, that that's a business and it's not a hobby. So the IRS isn't going to be like, oh, well, you took losses, because you document your intent. Now, what do I mean by documenting intent? You keep records. Intent is I'm keeping business records. That means I'm intending to make profit, right? I'm tracking my results. If you're looking at what you did and trying to think how to make it better, you do that out of an intent to make a profit. You're acting like a business, right? You're advertising. You're going on Facebook, you're going on Instagram, and you're telling people to come to your shows. That's advertising. That's intent to make a profit because you're trying to draw more people in. So if these things are happening and you're documenting, you're keeping your accounting, you have proof of these other things, and a loss year after year after year, don't worry about it. Obviously try to make a profit, but don't worry about your loss. It's not a bad thing. People get so stressed out and so worried, and you'll see a lot of business owners, if they don't fail immediately, it's around the 2 to 3 year mark because they keep making losses. They don't know how to interpret their books. They don't understand if they're trending in the right direction, and they get afraid of the IRS and they quit. I don't want that to happen to people. The other thing is, if you're adjusting prices, if you do a show and you take a step back and you're like, my pricing wasn't just right, I'm going to tweak it a bit. That shows an intent to make a profit in your business. If you're learning new skills, you're learning how to use software, maybe you're learning OBS, or you're learning how a bookkeeping system because it benefits the business, that shows intent. You're improving your operations, you're implementing systems, you're doing things in a different way. That's intent. And if you're analyzing your performance, you're going back, you're looking at your metrics, you're looking at all of those screens that Whatnot provides us, and you're saying, this is what these numbers look like, this is what they mean, and this is how I'm going to change it so I can make more money. If you're doing these things, you are a business, and you're documenting it the way you're supposed to, don't worry about the losses. This whole thing was about, all of those losses, and people get so caught up on it. Profit is always the goal, but it's not the reality sometimes. It just isn't. So here's a big thing though. While losses are okay, I'm like, don't let them stress you out. Obviously, we're going to, try to figure out what's wrong. We're going to try to fix it. Don't feel ashamed. Don't feel bad. All of that holds true, but never chase a loss just for a tax purpose. Okay. If you take a loss during the normal course of your business, okay, do not intentionally try to get a loss for tax purposes. So what's the difference in selling to support your hobby versus business? Business is intent. That's why. A hobby is, maybe I like model trains and I like to build train tracks in my yard and do this whole pretty thing. And I go to the train store and the guy asks me if I have a certain model that I'm like, oh yeah, I do. I'm not using it. Do you want it for $20? Here you go. Take it for $20. I'm not there to try to make money. I'm there for my enjoyment. I'm there to enjoy a hobby. I'm not trying to sell stuff. I'm not doing things with an intent to make a profit. I'm doing something with an intent to just get enjoyment out of it. That's the difference between the two. If you really want, I do have a PDF that talks about hobby versus business, and it goes through, the IRS has 9 factors they look at, 9 things to determine if it's hobby or a business. Because I'll tell you what, you could say, oh, well, I just do Whatnot for enjoyment. I made $10,000, but I just do it for enjoyment. You don't determine if you're a hobby or a business. The IRS does. So you do in the sense of, I'm going to file a Schedule C, or I'm going to make that determination when I file my taxes. But the IRS, ultimately what decides it is those 9 factors. So you can look at each of those 9 factors, and the commonality of those 9 is your intent to make money. So, and if you can't, you cannot tell me, and you will not be able to tell an IRS agent that you got on Whatnot, scheduled shows, set up shipping, thought about your pricing, purchased inventory, arranged your inventory, took your time to go live, and then shipped out your orders, and didn't have an intent to make money. You'd be very hard pressed to say that you had zero intent to make money, that was just enjoyment. So that's why pretty much every single person on here is a business. I may get it one time. I may be like, I did one show, wasn't for me, hated it. Okay, that was a hobby venture. It sucked, it's done. But if you keep doing it, you're a business. So let's go back to never chase losses for tax purposes. Never do I hope I lose money so I don't have to pay taxes. That's not really what we're talking about here. It's kind of like saying, I'm going to spend $100 to save $20. That's stupid business thinking. I'm going to call it like it is. It's stupid business thinking. How many of you have heard this? Put an emoji in the chat if you have ever heard somebody say, oh, it's okay, buy it, it's tax deductible. Or, oh, I'll buy it, I can deduct it on my taxes. What they're doing is justifying a purchase they didn't need anyways because they can save money on their taxes. So you're going to spend $100 to save $20. Don't do stuff just to, don't do things intentionally to have a loss on your taxes. It makes zero business sense. Don't buy something you didn't plan on just to, there you go, just to use the deduction. It is not worth it. Not at all. Thank you, Crystals. You are 100% correct, spot on. Okay. So that's a common, like, I know we've all heard it. Oh, it's tax deductible. I'll buy it. Would you buy it anyways? Why? Right? So tax savings are just a side effect of legitimate business expenses. Legitimate, ordinary, necessary for your business. What is my... You're still spending the money. Exactly. You're still spending the money. So there are things we can do. I'm about to talk about things we can do to reduce the amount of taxes legitimately, honestly, and necessary for our business. People that want to buy a car because it's a tax, no kidding. Oh, that was really popular when they had that whole 6,000 pound thing and that people were buying the trucks and the big thing. Well, this is tax deductible. I'm going to buy it. The amount that you're saving on your taxes is so minuscule to the amount you're paying in interest on that truck loan and the payments on that truck that it made zero sense. Zero. Now, if you already were car shopping, this was an absolute necessity you were already in line to do, that's a different story. But people were trading in their vehicles left and right for some tax deduction that it just made zero sense. So if you do have a loss, we talked about you're better off paying the tax. Exactly, Crystal, totally agree with you. When you have a loss, we talked about a lot of losses are a business problem. Business problems have solutions. So when you do have losses, we want to start saying, okay, well, why do I have the loss? Because ultimately we want profit, so we need to turn that around. So we start digging into it. Am I buying inventory the right way? Can I improve my sourcing? Am I paying too much in shipping? Can I change something on that? Is my overhead too high? Exactly. Is my pricing right? Am I not utilizing fees in a smart way? What do I mean by that? You can sell a bunch of stuff at $2, individual items that maybe are selling at $2 and you're getting hit with 30 cents on every of those $2. What if you bundled some together, sold 3 for $6? It's still the same $2 an item, but now you just sold 3 items and only had one 30-cent fee. That's part of being strategic and smart in your business and reducing your losses. Am I buying too many things for the tax deduction? Are you? I doubt you are, Crystals. I know you. I know you're a lot smarter than that. I can almost guarantee you think it through before you buy it, just from the things I've heard you say. So when you start digging in, whatever you answer, so when you say, "Oh, is my pricing right?" When you can answer yourself, "Hi, Lori," when you can answer yourself appropriately and honestly, then you can start seeing what the problem is that caused the loss, and you can fix it. Oh, that's a question you asked. Yes, now that makes more sense. So that's what Crystal says. Ask yourself, am I buying too many things for the tax deduction? Let's talk about how losses can be created strategically. Or I want to say created, not necessarily used. So I always do this example because I want to make it clear what we're talking about. We have our book income. We're keeping our accounting, our books. We want to make as much money at the end of the year, right? We want to have as much money in our bank account. That's this money over here. But then we have our tax return. We want this big high profit for our bank account, but for our tax return, we want this low profit so that we don't have to pay a lot of taxes. That's the goal. Right there's the goal of any business owner. A lot of money in my bank, paying a little bit of taxes, okay? There's ways to do that strategically. So if this is your profit and it's going up, we start at 0, it's going up, your tax is right in line with your profit. Now we can implement some strategic losses to bring our tax profit down so that we're paying less on taxes. What are some of those strategic things that you can do besides keeping your good documentation, making sure you're writing down all your expenses and you're not missing all of the normal deductions that are going on. You're tracking your mileage. You're utilizing the home office expense. So you're doing all the typical normal things that we hear about all the time. A few of the other things we can do: paying a child to help you. If you have a dependent on your tax return that can do work for you, you can deduct up to, I don't know the exact limits, 13 to 14,000. It changes every year, and I haven't looked for this year, on your tax return as payment to them without having to pay any other additional tax on that money. Like, they don't have to file a return. For example, my 15-year-old daughter works for me doing shipping. I pay her $15 an hour. I can deduct up to a certain amount off of my business, off of my taxes for that. Okay. The self-employment tax, we talked about that earlier. Retirement contributions. As a self-employed person, if you are not a W-2 employee, if you do not have access to a 401k or some other types of saving vehicle already, you can set up retirement plans for the self-employed and put money in there, which reduces the amount of taxes you're going to pay. So now you're saving for your retirement. You're making things better off when you get to retirement age. You're saving tax-free, and you don't have to pay that money now, right? And then SALT, which is state and local taxes. SEP accounts, various IRA accounts. Yep, I'm not a financial advisor. I can name some of these accounts. I do have a guide that talks about them. I won't advise on them because it's not my area of expertise. But they do exist, and I could tell you the tax implications. My son just graduated. He is 18. How old can I pay him and deduct it? Do I withhold state and federal taxes? Does he have to file himself? You can deduct it as long as he is still claimed legally as a dependent on your tax return. So while he's going through college, you should be able to claim that. He does have to work for you, though. So we can't just say they work for us. They do have to perform some work. You do have to keep a record of it, and it needs to be reasonable what you're paying them for that work. I can't say that my daughter ships 3 boxes a week and I'm paying her $5,000 a month to ship 3 boxes a week. It has to be reasonable, right? We got to be honest people about it. No, you do not need to withhold state or federal taxes. This is the beauty of it. He does not have to file. It has to be below that threshold, which I want to say it's between 13 and 15,000 this year. So as long as it's below that threshold, you can deduct it. He's working for you. You get some benefit, and he doesn't have to claim it on a tax return. Now, that's a little bit of an advanced tax strategy. There are some caveats to that. Nothing is ever just crystal clear and nice and easy with any taxes. So if you're going to employ that strategy, definitely talk to a bookkeeper, like an enrolled agent or a CPA, just to make sure that everything is done properly when you're doing that, so that you don't end up with anything on the back end. If you pay state and local taxes, you can deduct that if you're paying anything through your business. So depreciation is also the other way to reduce what you're paying. So there are a lot of different ways to create that gap between your book income and your tax income. Would my equipment that I bought for my business be deductible for just the first tax return and can be claimed every year? So that's where depreciation comes in. So when we talk about depreciation, we depreciate what we consider fixed assets. Fixed asset is an asset is something you own. A fixed asset is like a piece of equipment. What determines a fixed asset is that it exceeds a certain dollar amount and it has a useful life of greater than 1 year. So let's take a computer. Let's take a laptop. Okay, say you buy a laptop for your business. The IRS safe haven rule or safe harbor rule is $2,500. I think that's a little high for resellers, but if you were to say, I'm going to use the IRS $2,500 safe harbor rule, what we would say is, if that laptop cost more than $2,500, let's assume for this example it cost you $3,000. You got some fancy laptop, okay? You paid $3,000 for the laptop. It's expected to last probably about 3 to 5 years. So we would pick, what is the average? Let's go with 4 years. We expect this laptop to last. We have a couple of choices. Since it's going to have a life of 4 years, you can take 25% each year because you're taking the expense of the laptop in conjunction with the use of the laptop, the life of the laptop. So it's 25% each year. That's normal straight line depreciation. This is where tax strategy comes in, okay? Now, that's the default. That's what you go to. Then the IRS says, but hey, we're going to give you some special rules that if you want to deduct all of that, all 3,000 this year, instead of spreading it out over the life, over that 4 years, you can do what's called Section 179 and take the full 3,000 off your tax return this year. So let's think about how do we apply this in our tax return. And I'm using a very simple example, but if I'm a first-time reseller, this is my first year, I probably already have a lot of expenses and very little income. I'm already probably at a loss. Is that $3,000 really going to help me if I'm already at a loss? Probably not, because what do I expect to happen? Let's think that computer has 4 years of life. That's 25% each year. I expect to make more money in year 2 than I made in year 1, and I expect to make even more money on my business in year 3. So I can take 25% each year, and that computer can offset revenue where I'm making a lot more money in years 2, 3, and 4 than I made in year 1. So the deduction can help me down the road more than it may help me now. Or it can be the other way around. This is where you need to understand where you are now with taxes and where you expect to be in the next year or two. It's not just, oh, it's April 15th, I need to look at what happened last year. No, it's, I need to understand what's happening throughout the year and where I expect to be so that I can use these deductions strategically to offset future revenue too, not just current revenue. It gets a little complicated, but I tried to explain depreciation the best I can. That answers your equipment question. Because the IRS says a threshold of $2,500 is that safe harbor, most people just write it all off in 1 year. You as a business owner don't have to go $2,500. You can go with based on the type of equipment I buy, based on my business operations, I'm going to go with $1,000. Any piece of equipment, fixed asset, over $1,000, I'm going to depreciate over the life of that asset. So it doesn't have to be $2,500, but you do need to document how you made your decision and then stick with it. You can't change it year after year. You have to figure it out and stick with it once you start. But depreciation is one of those things that you can really work with strategically to help offset future income. And think about all the things you buy that has a life of longer than a year. Shelving, phones, cameras, TVs, if you're using TVs, iPads. There's a lot of things that you buy that you may want to depreciate. But you can't just depreciate everything. It has to be over the life of a year, and you need to set your threshold. If you guys have purchased anything, please check your DMs. My husband's trying to get that out to you right away. That is about all I had for tonight. Do you guys have any other questions? If not, we'll go raid somebody. So if this is your first time here, thank you for hanging out with me. I appreciate it. I am on every Friday evening for the most part. I do have a 9 to 5 and I travel frequently for my job. So there are times where instead of at night, I'll tack it onto my morning show. But I do have all of my shows scheduled out throughout the end of the year. They don't change very much. I do not believe in rescheduling shows. Thank you for being here. I really appreciate it. So if you're interested in any of the business or tax topics, a lot of the shows, the topic that I'm talking about is in the title. So you can always see hey, that interests me. I want to learn about that. And then I also sell vintage decor, and I'm on usually on Saturdays. I am traveling. I got to head to Dallas, but I will be on next Saturday. I'm doing a crazy creamer show. If you guys like creamers, I've got some crazy ones. I'm going to be loading that up probably on Sunday with some put all my items in there. So pre-listing everything. That was the word I was trying to find. But other than that, thank you guys for being here. We're going to find somebody to raid, and hopefully I'll see you back on a future show. I got a bookkeeper certification for users. Oh, cool. Well, yeah, come on in and let's talk. I love talking accounting. I'm kind of geeky like that. Who is on tonight? All right, honey, who should we go and see? We're just going to go to the first person on this list. They have 5 people. No, all right. I guess my husband's picking somebody. He picked good this morning, so let's let him pick again tonight. I'm waiting. I'm watching him like, who are we going to go raid?
Thanks
It's going
for
to be a
joining
surprise
us.
to me.
Have a wonderful rest of your day.
Who do you want to go to? I'll just type them in. Who do you want to go to? She's not on, honey. I'm just going to go to anybody because at this point where it's not working.
It says failed.